You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, today we're going to stick in the airlines. We'll look at last week's trade on Options Playbook Radio. We looked at a calendar trade in LUV, Southwest Airlines. And I find it to be an interesting trade because it was all about the setup. There has been major news in the airlines, and that's why I kind of want to stick with them. And that will be the theme for today's show. We'll look at last week's trade, and then we'll look at a long straddle in the airlines. As you may already know, there was a perceived stimulus package that could be happening in the airlines. President Trump tweeted about it. Doesn't necessarily mean that it's going to happen, but the stocks have all reacted positively. And because of that news, Southwest Airlines and frankly, all the airlines have made a decent move to the upside. Now, our long calendar spread that we were looking at was with puts. So we were a little bit bearish, and it was really about earnings and what was going to be happening and going into earnings. But as always on Options Playbook Radio, nothing's meant to be a recommendation. We're just supposed to be learning here. And here's actually a really good learning scenario in that we set up the trade fairly well. We set up the trade well in that the market has gone against us, and we're really not down that much on this underlying trade. And let me explain what has happened, and we'll talk a little bit about the setup because I think this is a great learning experience overall. Last week, we looked at doing Southwest Airlines. October 23rd was the expiration. Stock was trading at 37.5-ish, and the strikes that we looked at were the 36 strike puts. We had the October 23rd was the one we bought. The October 9th is the one that we sold. Now, the option contract that we sold had about 55 cents in it. The bid, I think, was 50 cents. And we were able to do this long calendar spread at a net debit to the account of 84 cents. That meant that this trade cost us $84 plus commission to put on, and that was our max risk. Now, our goal here was that the short-term option, the stock didn't go down $1.50, and that short-term option would expire, and hence we would be able to get long a put that would go out past earnings and do it for a much lower price. That put option that we were talking about, the one that we were buying, was trading for around $1.40 at the midpoint. Hence, we bring in about 50 cents approximately on all those things. And hence, we can get this entire trade done for a net debit of 84 cents to the account, quite a bit cheaper than buying that option outright. So what has happened? Well, the stock as of today, and I should probably mention that we're taping Options Playbook Radio. It's Wednesday, October 7th. The markets are closed. And Southwest Airlines today was up $1 and it was up a little bit yesterday, but it's now trading at $38.59. That's where the underlying stock is at, $38.59. Last week it was at $37.58. And we go and look at the net debit of that long calendar spread, and we see that it is now trading at 74 cents. So the market went against us $1. But 1 week of time went away. We are approaching expiration on that October 9th, that front month option contract. That will be 2 days away. So the markets are closed on Wednesday, got all day Thursday, all day Friday. And that option contract that we received 50 some cents for is now trading for under a nickel. So that means we put this trade on. We anticipated that the longer-term option contract would increase in volatility, and it has. And we're not even really close to earnings. Earnings are on October 22nd, and today is October 7th. So you still have some days. But implied volatility did increase. It could have been the news, could have been the fact that we are approaching that earnings event. But bottom line is, since we set up this trade the way that we did, we're only down a dime on that trade. And so you say, well, would I sell it and get out, or what else might I do? Well, if I look at the option chains, this is an opportunity to maybe roll it. You see that it's trading for next to nothing. There's still 2 full days of trading left. And if you look at that October 9th 36 strike option contract, that's trading for next to nothing. If I go out to the next week out, which would be the October 16th expiration, which will add another 9 days onto this, it still isn't at that earnings event as of yet. But if I roll out to that strike, that 36 strike option contract is trading for about 35 cents at the midpoint. So I could whittle this debit down even more. And hence maybe ultimately get this underlying down to about zero if we could. We could even roll the next month out to the 23rd and make it a long put spread by selling an option contract that is actually below the 36 strike. So many different opportunities, a lot of learning that we can do here from seeing this trade. But it's all about the fact that we set up a decent trade that would be profitable if the underlying went down. That was fine, but it went up. We didn't get hurt that bad. We now have an opportunity that we could roll out from the October 9th expiration out to the October 16th expiration, bring in approximately another 30 cents into the account and whittle down that net debit that was paid for that long calendar spread with puts in Southwest Airlines. All right. So with that said, I mentioned the news, so let's just keep with that theme. There's potential for an airline bailout, and it is interesting. A lot of analysts have kind of talked about it because there was an offering of debt to the airlines, and the airlines actually passed that up in general just because they felt like they're doing okay, and they didn't want to take on more debt. Now, after the tweet, the offering would be that they would just basically give them money that they would not have to pay back. There would be rules and restrictions around it, but that's kind of the concept, and that's what drove the airlines higher. It's not a done deal yet, but that's what the proposal was. So I like when I'm looking at underlying stocks where they're in the news, but you don't know when the news could happen. And we've done this before, actually, in the airlines. And not only the airlines, I guess you could qualify, you could put Boeing in this group, but we did a few long straddles on Boeing before the pandemic. And it was mainly because the news was all about when would the MAX start flying again, and there were headlines every other day on Boeing, and it was driving the stock up and down and increased volatility, but it wasn't known events. So in other words, you weren't necessarily paying up for that headline, but the stock was a little bit more volatile than normal. You had to pay a little bit for that underlying. So we're going to take that theme, and we're going to look at JETS, which is an ETF that tracks the airline industry. It's a fairly inexpensive ETF. Right now, JETS is trading at $17.65. It was up 48 cents on the day. And I'll mention once again that we are taping Options Playbook Radio on October 7th, and the markets are closed. So why not speculate? And this would be a 100% a speculation trade. We don't talk a lot about long straddles, and I know Mark and the rest of the options insiders over there don't always jump in on long straddles. But to be blunt, since the pandemic, the buyers of option contracts should have done better than sellers. Why is that? Well, the market has actually moved more than what the marketplace was implying. In other words, even though the VIX might have been up around 38, 40, got up to 60, 70 at some point, the market has bounced back more rapidly than expected. And if you were buyers of call options, you obviously got to get the direction right. You actually got more move than what was being anticipated in the marketplace. So we're going to hope that theme stays true in the airlines. And we do have some earnings that are out there and that are going to be announced. Like, for example, on October 22nd, we have Southwest Airlines that's going to be announcing. So there'll be a lot of underlying stocks that will be announcing at that point in time. So we kind of want to avoid that scenario. And we're just hoping that some underlying, that some stocks that the market will move prior to those earnings just based off of news in general. So we're not going to put a lot of money in on this, and that's part of the reason why I'm using this ETF, because it's a lower price stock. You could obviously pick your poison, if you will, to use probably a bad term overall, but do you want to look at this in Delta, Southwest Airlines, American Airlines? Where might you want to do a long straddle? And we're going to avoid a lot of the earnings dates. We're going to only go out 9 days on this. And we're going to look at the October 16th strike call and put in the symbol JETS, JETS. Right now that stock is at $17.65. We want to be at the most at the money as possible. So we're going to buy the $17.50 call and buy the $17.50 put. Now, if we do that entire trade, like I said, you're paying a little bit of juice. It's right around 40% implied volatility. If we go out further in time, the implied volatilities go up, and that's probably because of the earnings that are coming in all the airlines. But we could get this done for a net debit of $1.08 at the midpoint. Let's hope, not always a guarantee, but $1.08 at the midpoint. That means that on this one-by-one long straddle, we're betting $108 plus commission, and that will be our maximum risk. And all we're really looking for is a 1-point move in the underlying. The underlying stock moved today. It was up 48 cents. Not quite sure what it was up yesterday. Didn't really look at that. But so today on itself, it was up 48 cents. We're going to give it 9 days, and we're going to hope that it moves $1 in either direction. And this is one of these underlyings where you could actually leg out of it. If you were up $1 or more on the call side, you might want to think about selling it, especially if it was early, and hopefully the put would come into play. So it's a speculative bet, but I think it goes well with what we were talking about last week and the news headlines that we have. I still think that long calendar spreads are interesting plays on these stocks that haven't done as well in the pandemic. Going into earnings, trying to get into those option contracts kind of cheap, like we did last week in Southwest Airlines. But he had a tweet that caused some volatility. There is no rhyme to reason. Nothing's really changed in the fundamentals of the airlines. We just have a news event that hasn't actually been sorted out as of yet. So that usually means there's going to be more news to come. So with that said, I thought it would be interesting to look at a long, short-term straddle in the airlines. Okay, that's it for this episode of Options Playbook Radio. I have to let you know that on October 22nd, Ally Invest is going to be doing their own digital conference live on YouTube over at the Ally YouTube page. You can sign up for that event by going to ally.com/future of investing, all one word. That's ally.com/future of investing. If you have any emails you'd like to send to me, please send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.